We just heard from a series of CEOs and investors and analysts that they're all basically saying, boy, it's time to buy Europe, at least when it comes to equities. Does that make sense to you from an economist point of view? Vassili. Lena.
Hi. Yes, I think, well, look, I think that looking at the tea leaves of month-to-month changes in inflation or international comparisons has been a very poor guide to exchange rate development. So you just have to look at the spread between euro-dollar and Euribor over the last 12 months to realize that it's got nothing to do, really, with the exchange rate movement of the DNA of global finance, which is the dollar against the euro. Now, I think what makes sense, however, is understanding interest rate movements, exchange rate movements in the context of the global risk cycle. In the last 12 months, we're still seeing the early stages of an unpricing of the dollar's strength that occurred between 2014 and beginning of 2017, which happened in a very different international risk environment of concerns of the taper tantrum, concerns about a hard landing in China, questions about the strength and durability of the Eurozone recovery, and a deflationary oil price cycle. Compare this with today's environment of coherent global growth, of confident policy backdrop, of a reflationary commodities price complex, and it is a very different story. So I think that in a world where central banks are prioritizing growth over inflation control, it's too early to expect a normalization in exchange rate versus interest rate relationships.
Right. But on the flip side, Vassili, we talk a lot about investment coming back into Europe. Just this last week, we saw outflows of $2.4 billion in the U.S. and inflows of $3 billion into Europe. What does that wind up doing as cash continues to come into the Eurozone?
Well, that's partly the reason why you're seeing the euro outperforming interest rate differential, right? So there's been clearly a big asset reallocation story that has favored the euro. I think the story is going to continue. I mean, you showed a lot of opinions. There seems to be a strong consensus behind European growth, but I don't think consensus is wrong. It looks like there's scope for European equity markets to continue attracting inflows, and that's why we think the euro will be supported. In the foreign exchange markets, I think investors can also get a little bit more creative with how they want to play the European recovery. So let's not forget, there's not just the eurozone. There's there's the Central European economies that are highly geared to the euro. There's countries outside of the euro currency area, such as Sweden and Norway, that are also highly geared to that recovery. So there are opportunities kind of not just within the eurozone, but around it as well.